Good afternoon and welcome to Charting Points, a technical look at ag markets. My name is Brian Como. I am FBN's market analyst. Let's get into what is interesting for today. But first, got to read you the disclaimer. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material provided or is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, legal, trading, or tax advice. Neither Farmers Business Network nor any of its affiliates makes any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Of course, past results are not necessarily indicative of future results. All right, just wanted to take a look at some of the charts that I find interesting this week. First one here, we haven't talked about in a long time, if ever. I don't know if we've ever talked about oats on Charting Points, but today oats made a new high, posting 516 as the last trade here. Oats has been a very exciting market in the last little while, and one of the more bullish stories, or one of the only bullish stories, really like the way this chart is looking. Lots of trending things higher. As we can see, late last week we broke above some of this resistance here and continued to trade up as we went. So this is, I think, signaling some of the concerns, particularly about the Canadian crop and the losses there. So there might also be some demand playing in as far as buyers looking to cover some of their fall needs. So that might be something that is affecting the market as well. But needless to say, from a charting standpoint, this looks very, very good. All right, this is a monthly assessment of the oats. As you can see, we broke above some of this resistance here. We are kind of poised now to come up and test some of this resistance. If you want to get technical, that's at about $5.90 a bushel. So call it $6, although, I wouldn't want to put any targets in at $6 if the actual resistance level is $5.90. I do think it's probably a good idea to start layering in some target prices in here, particularly in this area. In this 560 to 590 area would probably be a good idea. This is one of those cases where, if you use the mantra, cut your losses short and let your profits run, this is a market that we are looking to let our profits run. At this point, it might start looking overbought, but I still think there's some legs to get it into the high $5 or high 5 area. So that could be something you want to put a target price in. I would expect, as you can see, there's a lot of consolidation here, even during the 2021 drought, just north of $6. Again, this year doesn't look as bad as 2012, although, where did I put my paper here? Hang on a second. Oats production in Canada, I'm using old-fashioned technology here. Oats production in Canada called 2.4 million tons. The 2021 drought year was 2.9 almost, right? So we got a bigger production loss. So we could see some good legs into this market, and I do want to be able to take advantage of that. Of course, we are at 0% sold for oats right now. So it is kind of starting to scare me a little bit. I do want to start rewarding some of these rallies and letting the patience that we've seen through much of 2022 and 2023 pay off. And we want to, as we move up to some of those levels. So just keep that in mind. You know what? I might get back to this chart because I think I put it in the wrong place, but this is canola, soybean, palm oil. I'm going to get back to this chart in a second. I do want to talk a little bit about corn first, though. So here is the CFTC managed money net corn position. It continues to get sold short by speculators. The last report showed 106,000 contracts short. I think what would be interesting to see, today is the cutoff for the next report. And as you can see in the last little while, we've seen some gains in this market, trading up to about $5 here, backed off a little bit today. But as we see this rise, if speculators continue to sell it short, I think that is a bit of a bearish signal. So when we see the results on Friday, if speculators tended to continue to sell this thing short as the market was rising, I think that means they're continuing to build up their short position as the market rises to try to get a little bit better profits when the market turns and goes south. This market does look bearish. The charts don't look super supportive right now. You can see there's some consolidation around the 20-day moving average. The only thing that's really been keeping this market up in the last little while has been the U.S. weather story, and you can even shave a lot of tons off or a lot of bushels off this S&D before that carryout starts to look heavy. So I think the funds are probably right. They're probably using this to kind of refill the toilet bowl before the next flush. We want to be aware of that. If we see it kind of punch down to new lows here, that would be a further bearish signal. Looking at wheat today, where we did definitely get some bearish signals today. Here's Chicago breaking down below support down to $6. Now, perhaps there is some psychological triggering there at $6 even. We may find a little bit of support there. However, Kansas City also saw some similar trade breaking down below support as well, trading down to $7.29, closing near the lows as well. We do want to point out that in these markets, this is December, Chicago, we generally do see some seasonal downturns into this time of year. Into September is when we generally see historical lows in this market. Same thing could be said for Kansas. This is the month of September down here. And we want to make sure that that we're keeping mindful of those seasonal trends. However, it's one of those cases where how far does it go before it bottoms? We're hoping that that support would hold, and that would be the bottom for the month of September, but it looks like the market is telling us otherwise. So there could be some downside ahead in the winter wheat markets as well. Minneapolis, a little bit of a different story, although it is still seeing pressure from those winter wheat markets. Now, Minneapolis got a little bit of a bump this morning when Stats Canada reported 1 million tons less than the market was expecting for spring wheat production, but it did close on a low, on a new recent low, and is moving towards testing the support that we saw down here at about 780. So again, if this market continues to fade and trades below this support line again, that could signal some short-term, or when I say short-term, I'm talking 6-8 weeks of weakness potential before we start seeing the seasonal rally. So there is some risk in these wheat markets, and we want to be cognizant of that in the short term. Did want to talk a little bit about the relationship between Minneapolis and some of the winter classes. This is the spread between Minneapolis and Kansas. We did see some strong gains in that today. So when you think about the Statistics Canada number and how it affected the market, it probably was more about keeping Minneapolis afloat a little bit stronger than the winter wheat classes. So we obviously saw heavier losses in the winter wheat classes, not as much in the spring wheat. So that's the effect that the 1 million tons of surprise got from Stats Canada. All right, moving on to soybeans, some good stuff here too. We saw a gap here. This gap here did not fill today, so it looks like it got pretty close, but it did not fill today. If we see some further weakness in the overnights, maybe it'll fill, but we still are in an upward trajectory here of soybeans. One thing I do want to point out, though, is as we get north of $14, which seems to be a bit of a psychological level, into this $14.30 area, I think there's some good opportunities to add some sales in here. There was a bit of a consolidation up here. Again, it's been struggling to keep up in some of these prices to some degree. And what we're seeing now is a bit of a skewed risk reward. It's trading still near 14. It can get up to 14. The high here was 14.35, but your risk now is kind of coming down into this 200-day moving average possibility at 13.30. So right now the risk to the downside here is larger than the potential upside. That's something to keep in mind as well as you're looking to price your cash crop at this time. Of course, a break above that 14.35 would be a further bullish signal. So anything you want to price in here and then wait until it kind of moves to a more bullish territory before jumping back in is probably a good idea. All right, moving into canola here a little bit. Canola trade today was a little bit disappointing in some ways, but surprisingly supportive in other ways. A lot of mixed signals here. Very hard to decipher today's trade based on what happened with Statistics Canada. So just to recap, Statistics Canada reported about 200,000 tons above the average trade guess. That was still within range of the trade guesses, but surprised the market a little bit to the upside. I think what surprised the market a little bit more, or at least what looked like it should have surprised the market a little bit more, was the addition of about 1 million tons of production in past years, including the 2021 drought year and last year as well. So there's 1 million tons of canola just on last year's production that got added to the balance sheet, and another 200,000 above what traders were expecting. The market initially overnight was trading lower, down to about 800. After the After the report was released, though, we saw, a gain. I think the largest gain was somewhere in the $6-7 area above yesterday's close, but it faded back to near opening values here. So the settle today, as you can see, was about 811.80, so a little bit larger than the last trade of the day, but not a lot from yesterday's close, which was somewhere around 809.10 was the previous day's close. So, mixed signals. We saw canola trade, the bar trade above yesterday's candle and below, so a pretty wide trading range today. But overall, a bit of a mixed bag as far as signals go in the canola market. One thing that I did want to point out as well, and this is where I'm going to go all the way back to my misplaced slide here, was vegetable oils. And I was talking back in late July, early August about the spread between canola oil and some of its rival oils needing to come in. It has done that now, as you can see, and is starting to look a little bit more normal. Just to kind of put this into a bit better of a graphical display here, I did kind of chart it out as a spread between canola oil and soybean oil. And as you can see, we've seen a couple of weeks here of some sustained value, about $430 US per ton spread in between canola oil and soybean oil. You can see there's a pretty big consolidation here through multi-months of consolidation, right around the 300 plus or minus, call it $50 or so. If we kind of extrapolate that out here, I think there's a possibility that this continues to trade down into this level, and it would still be at a pretty big discount to soybean oil at this time. So one of the reasons why canola oil might be struggling is that, or canola might be struggling, is that the oil is still relatively overpriced to other oils on the market. That is all we had for you today. I'm going to back up here. That's all we had for you today. Hope you had a great day, and StatsCan was exciting for you. We'll see you again next week with Charting Points. Thank you very much.